Have you checked out the performance of your bond fund for the month of February? We got some interesting things to share with you, and the results may surprise you quite a bit, considering that after all, it's a bond fund. It's a U.S. government bond fund. What could possibly happen there? Well, we've got a story to share with you, particularly based upon what happened during the month of February, plus the latest not so friendly gift from your employer, the slew of costly and poor performing advice that is available inside your employer's 401k. Underperforming, paying for underperforming advice is never a good idea. Unfortunately, a lot of plans are delivering that. So we'll talk about that, along with how you can pay less taxes on your retirement account withdrawal. So welcome to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also happened to be one of the top 25 financial planning podcasts on the World Wide Web. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life with a successful and cost-effective retirement plan. So it is Sunday, March 7th. That's when you're hearing this program, but we are taping this week on Thursday because Sunday, during the course of the program, we will hopefully be running a marathon. We tried that like 3 or 4 weeks ago over in Melbourne, and then the storms came in and we got sort of canceled halfway through, and I'm like, man, I've trained for all of the months that I have, as I do each and every year for the past few years, to kind of run a marathon once a year in this sort of time frame. I didn't really want to go that to waste. So I got online and found another race that was running. And of course, this time of year, or this season, you've got to kind of search more than what you might otherwise have searched, because with the pandemic, a lot of those races are getting canceled or they're running virtually. No, I like the real experience. Thank you very much. So we are going down to Stewart to run, I think it's the Gold Coast Marathon or something like that. Anyway, so hopefully by the time you hear this, the end of this program, I will be close to probably mile 24 or something. Race starts at 6, hoping to finish in 4.5. So anyway, that's what's going on in the real world. Meanwhile, on the program, we've got much to talk about because we are exactly 39 days out from April 15th. That is the tax filing extension. That's the tax filing deadline. No extensions this year, and that's the point. Many of you are experiencing difficulty in tracking down tax documents. Like a lot of institutions, of course, not probably operating as efficiently as they might have, particularly as a result of the pandemic. So we've seen delays, if you will, on the receipt or the mailing out of various tax documents. So that's sort of slowing down the process. And then even from a form perspective, there's a lot of changes to this year's taxes, particularly involving those stimulus checks and COVID distributions out of your retirement accounts. And a lot of the software programs out there, even that accounting and CPA and tax preparation firms use, haven't even fully updated or fully have the full and final version of all of the tax forms that you actually need to file a tax return. So despite those major roadblocks, if you will, to getting things done timely and efficiently, the IRS is not throwing you a lifeline. They have come out and said that we have no intention of extending the deadline past April 15th. So if you're thinking they're going to give you an extra 3 months like they did last year, that, at least right now, is not in the cards, and there's no indication that they are leaning that way. If anything, they are leaning towards keeping the April 15th deadline as the normal hard deadline. So be aware of that. And yes, understandably, it's hard to track down those forms. Many of the tax document forms aren't even fully updated, but that doesn't change. Still got to hit that April 15th deadline. You got 39 days to do it. Speaking of last year and some of the changes from last year in terms of the shifting of the tax deadline last year, the reality is, I don't know if you saw this stat, but the IRS is way, way, way behind. It continues to be way behind. And what's fascinating about that, rather than figure out a way to sort of get ahead or solve the problem, they just spend more money. And in fact, according to the latest GAO, General Accountability Office report, Government Accountability Office report. That's a maybe a little bit of a misnomer there, right? Government Accountability Office. I'll leave you to figure out that comment. In fact, there was about $3 billion spent by the IRS on just interest that the IRS had to pay on refunds that they were not able to timely process. Let me repeat that. So you file a return, you're getting a refund. The IRS owes you that refund and they must pay you that refund within a certain amount of time. Well, if they don't process your return timely, then you get interest on that refund. The cost of that was about $3 billion last year. Now, I mean, nothing like promoting inefficiencies, right? But we'll just take more taxpayer money and we'll just throw another billion here, another billion there on it. Of course, I guess $1 billion in comparison to $1 trillion is a much smaller amount, but you get the idea. It's just that mindset of, rather than actually speeding things up, rather than actually solving the problem, yeah, we're just going to pay a bunch more interest, which gets us to the Government Accountability Office's recent review of the IRS. So see if you would like this description in your annual employee review that your employer gives you. Here we go. Ready? This is from the Government Accountability Office. IRS overall performance was significantly impacted by its reliance on manual processes, such as for paper returns, and its limited ability to process returns remotely while processing centers were closed. The General Accountability Office report continues. As a result, as of December 2020, the IRS had a significant backlog of unprocessed returns and taxpayer correspondence. That's not a good review. If you get that as an employee, words like over-reliance on manual processes and limited ability and a significant backlog, you better watch out. Two real problems come from this, okay? Two real problems come from this. Number one, there's a backlog of 6.7 million tax returns from 2019 at the end of January of 2021. Number two, the computerized letters are still getting generated. And what we're finding is that they're not really recognizing or reacting to your response that you are given, which makes it very difficult. The only thing you can really do, if you've got to have a correspondence with the IRS, is that you've got to fax the correspondence in. That's the only way they're really even keeping track of it and seeing it. So if you get a letter from the IRS, make sure you're faxing it in these days rather than mailing it in, because they're not opening their mail. With that, we'll return after these messages. So just to recap what we were talking about in that last segment, the reality is the IRS very, very far behind, but that's creating problems. Two problems: nearly 7 million tax returns for 2019 still unprocessed, and then number two, the computers are still sort of scanning the returns and sending out these computerized letters that folks have to respond to, and then they're not opening the letter, and then they're sending out another computerized generated letter to follow up from the first computerized generated letter. So what we're seeing is such a lag in terms of them processing just correspondence mail, because that's the one that you've got to kind of open up and actually read. The reality is that we're finding that folks are getting quite frustrated because you get one letter from the IRS, you write a letter, you respond, and then you get another letter from the IRS that basically repeats what the first letter said, and now it's adding interest and penalty to it because you didn't respond to the first letter. Well, you're like, well, wait a minute, I did respond. I mailed something. What we're finding is that because of the backlog, because of the fact that they are not opening their mail, the best option, if you're going to correspond with the IRS based upon a letter that you got from them, you've got to fax it, because that's the only way that it sort of gets directly into their system, if you will. And then you also have the proof of having sent that fax on a specific day and a specific time. So just keep that in mind if you wind up getting a letter. It's certainly a very frustrating process right now dealing with the IRS, and heaven forbid that you actually pick up the phone and call them, because that's going to be a whole nother process. So just be aware of what's happening with the IRS these days, and understand that if you get some correspondence, it's going to be probably better off to go ahead and fax it. So speaking of things that sort of don't happen very often, I don't know if you got the opportunity to really look at the performance of bond funds for the month of February. It was not good. And so if you're looking at a U.S. government bond fund, which U.S. Treasuries, right? Can't be much fluctuation there. The reality is during the month of February, which after all is a short month, a government bond fund, and for that matter, a general bond fund, was typically down about 1.5% in that month. Meanwhile, the S&P 500 during the month of February was up 3%. So what's going on there? We're going to talk about that in this segment. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. Our program also happens to be one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you check us out on your favorite social media or podcast channel. My name, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So what's going on there with the performance of bond funds, and you know what the future may look, because bond funds generally are thought of as not the category that fluctuates, right? So, you know, stocks usually are the ones that fluctuate the most, but lo and behold, there we have the month of February where U.S. government funds and general bond funds were actually down about 1.5%. Meanwhile, the overall markets were up about 3% for the month. So the reality is, and this is February sort of a good reminder that and all investments, whether they be stock, whether they be bond, whether it be real estate, whether it be Bitcoin, whatever it is, anything you put your money into, the value is going to fluctuate unless it's sitting in a savings account or a CD or something like that. So anything you're putting your money into, all of them are going to have some level of fluctuation. The reality is bonds certainly fluctuate over time a lot less than stocks, and that's why bonds typically are some portion of the portfolio. In our view, typically most investors are probably too heavy on the bond side, or generally go there too early on their path to retirement. But that's obviously a conversation, and we've certainly done a different conversation. We've certainly done plenty of episodes on the show about that notion of having the right allocation. But ultimately, I think it bears a little bit of analysis in terms of what actually happened during the course of the month. So with the added stimulus discussion, and that is still ongoing. Again, we're taping on Thursday because running a marathon this morning down in Stewart. And as of Thursday, the latest round of stimulus had not officially passed through the folks in Congress. And so what was going on during the month of February is that a lot of folks and a lot of investors and a lot of the public and a lot of the economists started to say, well, with this additional stimulus, yet looking at some of the numbers that we shared last week in terms of household savings and things like that, just how high those numbers were. Household savings about at 3x what it was prior to the pandemic. You start to think about, well, if all of that cash is out there and they're still going to pump even more into the system, at some point does that start to be inflationary. And so that wound up contributing to a pretty quick increase in the yield on the 10-year US Treasury. At the beginning of the month, that yield was just slightly over 1%, 1.007%. By the end of the month of February, that yield had gone all the way up to 1.459%. Well, that's a pretty significant jump, and in fact was the largest 1 month increase in the yield on a 10-year Treasury since 2016. So the largest jump that we've seen going back 5 years ago. And here's the general rule: if interest rates go up, bond prices go down. So when that happens, interest rates moving up, you may think, well, wait a minute, aren't I going to get a little bit more in interest? Aren't I going to get a little bit more on the coupon? And yeah, that is correct. But with owning a bond fund that's a collection of bonds, you're going to also see where the underlying valuation of those bonds actually decline. So from a valuation perspective, you actually see the principal in that bond fund go down. And that's the concept of how interest rates and bond prices move. So when you have a jump up in interest rates like we saw in February, you also have a similar reflection in the price of those bonds, because those bonds are, in essence, the price goes down to reflect the fact that it is in fact paying a higher interest rate. So it's one of those inverse correlations, if you will, that works with that works on the bond side of things. And so this time, it warranted a pretty dramatic move in terms of the price. So what's the takeaway? What does all that mean as an investor? What are the things I need to be aware of? So number one, first and foremost, beware that bond funds do and can lose principal. Just like any other investment, they can in fact fluctuate, and you can run into periods of time, particularly when interest rates jump up, where the value of them ultimately goes down. Cash in savings or a money market or an insured money market or a CD is the only way to avoid any of that fluctuation. Problem with that, of course, is that if these fears about inflation are true, and probably are, then the reality is that based upon how much you're making with that money sitting in cash, you're losing money there as well, because inflation is eating away at the buying power. So understand that about bonds just in general. And then number two, know your bonds. And no, we're not talking James Bond and the actors that played them, but know the bonds the type of bonds that you have in your portfolio and the nature of those bonds. There's really kind of three things to be thinking about when you're looking at the mix of your bonds in your portfolio. And first would be maturity. Is it short-term or long-term? Short-term is going to be less subject to principal fluctuation because it's a much shorter period of time. Those rates have a tendency to be a little bit more stable versus longer term, and those interest rates can fluctuate and lead to principal fluctuations. So understand the maturity. Number two, understand who the issuer is. Is it the U.S. government? Is it a corporation? Is it a mortgage? If it's mortgage backed, understand who the issuing entity is, because there's different risks there. U.S. government obviously would be the lowest risk. Some corporation that is barely making money, that would be a much higher risk. Both of those entities, government entities, state entities, local entities, and businesses, can in fact and do issue out bonds. And then lastly, the rating, all right? I mean, AAA, obviously better quality versus if you just start getting into the B's and C's, those are lower quality and come with them more risk. So understand the nature of bonds. They do in fact fluctuate, and so you need to be aware of that, but also understand what you need to look at as an investor to really get an understanding of what is in those bonds. Maturity, issuer, and rating are the three big key concepts. With that, we'll take a break and return after these messages here on Dollars and Cents. We talked about this a few weeks ago on the program and the podcast, and so but it does bear repeating. And the reality is, or the concern is that we have, is that we're seeing these types of options get offered through courtesy of your employer plan, And the reality is, what we're finding is that investors are overpaying for underperforming advice inside their employer sponsored plan, whether that be just 401k, their 403b, or what have you, courtesy of the employer. And so we're going to tell a story on the program today to help sort of clarify and illuminate this issue, and hopefully give you an incentive to make sure that you're not falling into this same trap inside your own employer's retirement plan that they are offering, whether that's a 401k, a 403b, or a 401a. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So let's set the table with a story, a real story of someone who came in to the office this past week. And this has to do with a major employer in Central Florida, along with a major player in the employer-provided retirement plan space. So big players, and this is not just some one-off story that is unique. These are major employers and major providers of retirement plans. And in this particular case, the employer was changing the provider. And that happens in today's world an awful lot, because employers are constantly sort of chasing for the lowest possible cost when it comes to the plan that they're going to offer for their employees. And the employer always wants to have their cost as low as possible, and then ultimately the employee in essence bears the costs. And it used to be back in the day where you would go and you would sit and do a big presentation to a company about the 401k and the funds that they would offer, and then you would even go so far as to sit down with each individual employee who was interested in signing up and kind of go through the options and talk to them a little bit, and actually have some one-on-one, in-person, personalized advice. And so back in the day, we used to do that as well. Our focus is not really on employer retirement plans as a business, but certainly from time to time we found ourselves doing that. But as you might imagine, there's an internal cost in that, and employers are looking to sort of strip away all of the internal costs and break them out so that they are separate costs. Somehow along the way, the financial industry has convinced the public that if you break out costs, that somehow that's better than if the costs are all internal. The problem is that that's a little deceiving, because in order then to get to your total cost as an investor, you have to add different pieces together. Well, most investors that we talk to don't even really look at their statements that much, let alone get to page 18 that gets into the details of the breakdown of the cost. And so what happens is you have this sort of splitting up, if you will, of the different costs that are happening inside of a employer plan, and really across the industry in general. And then people only hear certain pieces, right? So you might hear the piece about how much the advice is costing, but you don't hear the piece about how the investments have a higher, or just in general have a expense internal in them. And ultimately, to get your true cost, you've got to add those together. And no one really ever kind of explains it like that. But the reality is that a cost is a cost. Doesn't matter whether you refer to it as an expense or a fee or a separate management fee, it's still a cost. And so we're seeing that same thing happen on the employer side of things. And so employers looking for, kind of the lower cost, but then they also then are providing this advice, if you will, that they're building into these 401ks. And so they're basically looking for cheaper costs and less liability in their plans. And the problem is that means that investors are getting computer program driven type of advice that ultimately costs you directly and is overtly more conservative. So anyway, back to our story. So in this particular case, this employer plan was offering personalized planning and advice inside of the plan itself. Personalized, not based on a personal conversation, but rather you going online and kind of filling out your personal profile, and then from that, then they'll put together some type of a mix. The key concept that we have with that, and one of the things that we always struggle is when you complete a profile to determine what your investment mix is going to be, you know what's happening there. You're being told exactly what you want to hear. And folks, there's a difference between being told what you need to hear and what you want to hear. And that's the problem with profile or fill out this survey or answer these 10 questions when it comes to creating an investment allocation. Because you're going to fill that out based upon, what you want. But what you want, and ultimately the answer that you get when you sort of presuppose here's what I want, it is going to be very different than what you need to hear. A 30-year-old investor may want to have no fluctuation in their account, in their retirement account, but at the end of the day, what they need to hear is, wait a minute, you're 30, you're not going to be able to really access this money until you're 59 and a half, so like 30 years from now, you shouldn't be going in a conservative manner in your investments, because ultimately that means you're not going to have enough money in retirement. So that's the difference between being told what you need to hear versus what you want to hear. And the problem with these computer-driven surveys and profiles and fill out this form is you get exactly what you want to hear. So that's problem number one. Problem number two is that these personalized advice and services inside a 401k platform come with a cost. In this particular case, it was about an additional 0.3%. So that's on top of the expenses of the funds themselves. There's one more catch on this, and you are automatically enrolled into it. You have to literally opt out. You have to do something, otherwise you're automatically into this sort of program costly type of approach when it comes to your retirement. Here's where it gets even worse. The advice is terrible. In this particular case, this person was being told to go 80% to bonds. That, folks, not going to get any type of return on that, particularly in low interest rates. So the wrong mix, not personalized at all, high cost, beware of that, and beware if your employer has that in your plan. We've seen a lot of people who didn't even realize that that was part of the plan, but again, because they have auto-enroll features where you have to opt out, you wind up getting auto-enrolled and it's costing you money and you're getting terrible advice. As our ad says, don't overpay for underperforming advice. Unfortunately, that's happening in a lot of 401ks these days. So investors, beware on that when it comes to your employer plan. So it's tax season, and you're looking at your taxes and you're thinking, how can I reduce my taxes? Particularly if I'm retired and taking income from my retirement accounts. What are some of the ways in which I might be able to reduce taxes? So in this segment, we're going to talk about some of the things that you can do to help manage that tax bill, not just for this year, but looking ahead to the years in front of you. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So what are some of the ways in which you can sort of avoid some of these tax implications on withdrawals that come out of your retirement accounts? Well, chief among them is looking for ways to avoid the 10% penalty that applies if you take that money out before age 59 and a half. The best way to avoid it is don't take the money out, because the reality is that you're not only paying a 10% penalty to do that, but you're also paying taxes on what you took out. Oh, and you're also completely undermining your retirement as well. But the reality is sometimes folks want to retire at 56 or 57, maybe before 59 and a half. Well, there's ways to get income out of a retirement account without having to pay that penalty, particularly if you are over age 55. It's one of the biggest reasons why typically our recommendation, if you are leaving your employer at age 56 or 57 and planning to retire, you want to leave the 401k where it is and not actually roll it over to an IRA, because the 401k or the 403b offers you an exception to the early distribution penalty. If you are over age 55 when you retire, you can draw out of your employer provided plan and not have to worry about that 10% penalty. So that's a pretty unique feature that most people aren't aware of, that specifically addresses folks between age 55 and 59 and a half who want to retire out early. Of course, the problem with that is if you're retiring at those ages, you got to worry about your health insurance, but that's another conversation for another show. Anyway, but that does allow you to avoid the 10% penalty. One of the exceptions that is unique to last year in terms of avoiding the 10% penalty is, of course, the COVID distribution. Those rules allow you to avoid the 10% penalty if you took money out because you were affected by the COVID pandemic. So other exceptions to that 10% early withdrawal penalty are if it's a first-time home purchase or college or medical. So you want to make sure that you're avoiding, if you want to reduce your taxes on your retirement withdrawals, you want to make sure that you are avoiding the early withdrawal penalty of 10% that typically applies before age 59 and a half. Number two, if you want to roll your 401k over, make sure you do it as an actual rollover process that goes from one fiduciary, one trustee to another. If it goes through you, then typically what happens is a 401k is going to withhold 20% for taxes, which means that you only get like 80% of your money. Well, if you only roll over 80% of your money, guess what? You're going to have to report the 20% that was withheld and sent to the IRS. You're going to have to report that as income on your tax return and pay taxes on that. So if you're going to do a 401k, move a 401k over to an IRA, don't take receipt of the money because of that automatic tax withholding that happens. If you wanted to avoid then the tax implications that would be on that tax withholding money, you'd literally have to write a check for 20% more than what you got. Well, you can avoid all of that by telling your 401k, hey, make the check payable to the new IRA custodian, and then that way you don't run into that, because when you do that, you wind up paying taxes on money that was withheld to pay the taxes that you're not going to have to pay because, in fact, you were ultimately rolling it over to an IRA. So just be aware of the process on that. Otherwise, you could wind up paying taxes unnecessarily. Another important issue in terms of remembering to do to avoid or reduce your taxes is make sure that you take your required minimum distribution for the year 2021, and for that matter beyond. Last year was a rare year where they suspended the required minimum distribution, so you didn't have to do it. I can remember in my mind only one other time after the financial crisis of 2008 where they allowed people that option as well. They are not offering that option this year. There's no conversation about that, and so consequently the RMD fully returns. So who's susceptible to the required minimum distribution from a retirement account? Well, new age, 72, so that's courtesy of the Secure Act that passed last year, so it's no longer 70 and a half. It is in fact 72, and anybody that is a beneficiary of a retirement account. If you're a beneficiary of a retirement account, you may have to take distributions out based upon your life expectancy, or if you became the beneficiary more recently of a retirement account, then you've got 10 years in which to make sure all of that money is out of that account. So a couple of different rules on that. The reality is that the penalty is 50% of what you should have taken out to any required minimum distribution. So if you got a required minimum distribution, make sure you take it out. Otherwise, you'll have to pay a penalty equal to 50%, pretty steep, of what you should have taken out. Another important thing to remember is as you approach that age 72, understand that in year one of your required minimum distributions, you've got the ability to delay that first year distribution up until April 1 of the year following the year in which you turn age 72. The whole delay the first year option still exists, even though the age increased from 70 and a half up to 72. But here's the thing. If you delay that in year one, you still have to take out a distribution for that year as well. So effectively, you wind up taking out twice as much of a distribution in that first year if you decide to delay it. So generally, our advice is take your RMD out each and every year. Don't elect, unless there's a good reason, and there might be, but don't elect. You got to run the numbers to know if there's a good reason. You can't just say, oh, I'm just going to delay it just for the heck of it. The reality is that more often than not, having an equal amount each and every year and not doubling up that first year probably is a good strategy. Some of that requires some in-depth analysis, but just know about that option. And if you're doubling up, if you're delaying it, it's not like you can then delay everything going forward. If you delay that first required distribution, you still got to take a second one. So effectively, you wind up doubling up in that year. So just be aware that that can trigger some additional tax consequence. Another very popular one that we like to talk a lot about in order to reduce your taxes on your retirement withdrawals. Speaking of required minimum distributions, you can do what is known as a qualified charitable distribution. A QCD allows you to tell your IRA custodian, please make the check directly payable to charity ABC, and that way that amount winds up coming off of your tax return as income altogether. Be aware though, you can't get the money and then write the check. The IRA custodian has got to write that check directly to the charity. So make sure you keep the qualified charitable distribution in mind as a way to reduce down your taxes as it relates to your retirement account. And then one of the things to also think about is maybe you don't wait until your required minimum distribution age to start taking money out of your retirement account. Maybe you start to take out a smaller amount along the way, particularly depending upon where you're falling in the tax bracket. Now that's a little bit deeper analysis that looks at your investments and your income and how all of that works together. But the reality is if you do a deeper look at your tax picture, you may find that you may want to take out a little bit more or a little bit along the way before you even get to that required minimum distribution age. So those are just some of the ideas to be thinking about in terms of how to reduce your taxes. With that, we'll wrap it on up and get on out of here. Have a great rest of your Sunday.